So the government just announced some good news for first-time home buyers. If your mortgage is insured, meaning your down payment is relatively small, let's call it 5%, meaning you're probably tighter on cash than you'd like to be, you will soon be able to stretch out the length of your mortgage. So get a mortgage that's amortized over 30 years instead of 25, which is the usual limit right now.
That translates to lower monthly payments, so more younger Canadians can afford to pay that monthly mortgage on a new home.
And by the way, that's an important detail she just pointed out. Not only is this just for first-time home buyers, it's also only for newly built homes. But is it good news? You know, lots of economists and policy wonks do see this as an empowering move. Give people more options, a clearer path to the housing market. And it's worth mentioning, in the US, 30-year mortgages are pretty normal. But while longer loans do mean lower monthly payments, there are some downsides that the government isn't exactly advertising. Some of them obvious, some a little less so. Let's go through both the pros and the cons. So the easiest way to explain this is with a hypothetical scenario. So let's say I'm buying a $500,000 house. Dream world, I know, but just bear with me. So typically, I'd like to put down 20% as a down payment, which, where's the eraser? I don't have. So let's forget about that. Let's say I can only muster a 5% down payment. That means I only need $25,000 upfront cash, which is still difficult, but let's say it's doable. To compensate for the fact that I'm now a slightly riskier investment for the bank loaning me the money, I'm probably going to be required to buy mortgage insurance, which for this kind of down payment is 4% on the total loan tacked on. So that's $19,000 extra dollars that I have to pay back on top of the $475,000 of my mortgage, right? $500,000 minus the $25,000 down. So my mortgage total, bear with me, is $494,000, okay? So now I have to decide what I can actually afford to pay on that loan on a monthly basis. So let's say these days I can get my bank to give me something like a 5% interest rate over a 5-year term. And because, I'm not the richest guy in the world, I opt for a 25-year amortization period. So let's do that over here. A 25-year period, meaning I should mathematically be able to pay everything back plus interest in 25 years. My monthly payments on that schedule would be $2,873.13 per month. But let's stretch that out to a 30-year mortgage. Again, on that schedule, that means I can spend an extra 5 years paying the loan back. Now my monthly payments drop to $2,636.43. So you do the math, this minus that, that's almost $250 a month extra in my pocket that I get to keep. But of course, this calculation leaves out two other very important numbers. One, because I'm paying back my loan over such a long period of time, I'm paying a ton of interest. So I'm not just paying back $494,000. On a 25-year loan, I'll actually end up paying $861,938.59. That's almost $368,000 extra dollars just in interest. But on a 30-year loan, my total payback jumps to almost $950,000. So now I'm paying back nearly double the original loan, more than $80,000 extra compared to the shorter 25-year loan.
Of course, the longer the amortization, the greater overall ratio between principal and interest per payment.
And here we are at the first big downside to stretching out a loan. You pay less now, but you pay more later. And that really sucks if you're already looking forward to getting out of the rat race. Check out how Canadians have, over time, been retiring later and later in life, from a median age of 60 about 15 years ago to about 65 more recently. Add more debt, maybe you push your golden years back a little further too. You're also building equity in your home more slowly, meaning with each monthly payment, less of your money goes towards actually owning your house and more goes towards servicing debt. If things go sideways, so let's say you lose your job or interest rates go up and you just can't afford the mortgage, even at 30 years, you walk away with less.
If you start missing those mortgage payments, it will damage your credit. Once your credit is hit, the damage is done, right? And it's very difficult to repair that.
But there's one more thing economists worry about, an unintended side effect of giving people more purchasing power by allowing 30-year mortgages. And that is, you might, at the same time, actually make housing more expensive. Again, this concept is easiest to explain with an example. So let's say I'm selling my home. I put it on the market, but housing isn't exactly affordable right now, so I only get one potential buyer. That's fine. I get a decent price and I move on with my life. But now let's say, under these new rules, housing isn't any cheaper, but people can afford more, borrowing more against their future with these fancy new 30-year mortgages. So now I get 3 people bidding for the same house. And guess what happens to my bottom line as a seller when more people are competing? You got it. I sell for more.
There's going to be a lesser monthly payment on the mortgage. Affordability has improved a little bit, but I see purchase prices and property values increasing as well.
Greater the demand and with limited inventory is going to drive pricing upwards.
And you know why we know this is a real risk with this plan? Because Canada used to allow 30-year insured mortgages, and in 2012 decided, let's stop doing that.
The government is tightening mortgage rules, basically reversing its own decision to loosen things back in 2006.
Now, it will mean that some people will not buy into the market.
Ottawa decided 12 years ago to rein in the hot housing market by capping insured mortgages at 25 years. This was at a time when almost half of all new mortgages were 30-year mortgages. And Canada used to allow 35-year mortgages. And before that, we used to have 40-year mortgages. For all kinds of reasons, government after government decided long loans weren't always a good idea. This most recent change represents the first time in a long time that the pendulum has swung back the other way.
As of present, it's needed, right? So double-edged sword, meaning their consumers are going to pay higher interest costs, but it's needed due to current interest rates and rising property values, all the items, the pains that we've discussed.
To be fair, there are clear arguments in favor of 30-year mortgages. They help give younger first-time buyers a fair shot at the housing market, and longer loan runways kind of make sense for people who have their whole lives ahead of them to pay those loans back. But make no mistake, ask any expert, they'll tell you, the backbone of Canada's housing crisis is all about supply, or a lack thereof. Answering Canada's housing affordability crisis by allowing Canadians to take on more debt doesn't get at the root of that problem.